Traders are waiting CPI at 8:30 Eastern Time for clues about how much the Fed will cut rates this time next week. Concerns are lingering over whether the central bank has waited too long. Mike Wilson of Morgan Stanley writing, until the bond market starts to believe the Fed is no longer behind the curve, growth data reverses course and improves materially, or additional policy stimulus is introduced, it will be difficult for equity markets to trade with a more risk-on tone. Mike is with us around the table. Mike, good morning to you, sir.
Good morning. How are you?
I want to pick up on that quote, and we're doing great. I want to pick up on a line that you're focused on. The difference between Fed funds and the front end of the yield curve, Fed funds in a 2-year, and that quote, how important is that?
Well, that's a signal that we're getting from the bond market. The bond market has historically been a pretty good indicator of where the Fed is relative to kind of what they need to be doing. And we saw this, by the way, on the upside, too, right? In the 2021 timeframe, the 2-year got ahead on the upside. So it's the same picture, just on the other side. And you know, people complain, oh, they don't complain, they say, well, look, the stock market is behaving fine, but that's not true. Internally, once again, you know, defensive stocks are really doing extremely well. So I think the stock market is taking its cues from what the bond market is saying. It's not saying hard landing yet. What it's saying is that growth has continued to disappoint. So since April, and we've been on this program many times since then, I would say that the data's been distinguishedly negative in terms of growth data. Also, the labor data has been much worse. So how has the equity market dealt with that? Well, it's pivoted from what I call quality growth to quality defensives. And we made that pivot in May, and that's classic late cycle behavior. So I think everything kind of sinks. It's just we're waiting for the, you know, like, can somebody give us the keys to the test? You know, the cliff notes, whatever it is. Like, how's this going to end? And we don't know.
But the market's, ask you, don't you? I'm going to ask you. Basically, you've said we need one of two things. Either the Fed cuts aggressively, or the labour market starts to improve and improve quickly.
That's right.
For equity markets to perform well. So have you got a base case? Is it one or the other? Do we get one or the other?
Well, what I would say is that the Fed could get ahead of the curve if they decide, but the problem, they're constrained. Okay, they're constrained by two things. Not inflation, by the way. Inflation's over, as far as I'm concerned. Inflation, they beat that. What the issue is now is the currency market. If they come in and start cutting aggressively, the yen-dollar relationship is going to create some stress. So they got to be careful with that. The other thing I would throw out there is, we've looked at this, when the Fed starts a cutting cycle with 50 basis points as opposed to 25, the chance of a soft landing goes down materially. And they know this. They know this data. They don't want to signal that. So they're in a tough spot. The Fed's in a difficult spot. They've done a good job of trying to navigate this, you know, challenging, different environment that we've been in for the last several years. But now the markets are pressing them. And so next week, I don't really care what they do next week. What I care about is how the markets react. How do the markets behave after they've done what they're going to do, 25 probably, and then what do they say in the press conference?
The vibes, whether they actually work for the market or
That's
not.
Right.
I'm curious, though, before we go into quality growth and quality defensive and what that actually means, you said something about the currency differential. Are there certain target levels that you see sort of unwinding some of the longs that still remain out there? Do you have a sense of just how disruptive the ongoing long trade for the dollar really will be potentially down the road?
Yeah, I mean, I don't have a specific level, but I do feel like they're trying to defend this low 140s level between yen dollar, so call it 142. If we start to, you know, 130-ish, you know, 138, 139, I think that could cause some stress in other markets.
Meanwhile, you talk about shifting from quality growth to quality defensive. I've struggled with these monikers quite a bit, simply because what does defensive, what does growth mean? Where does NVIDIA fit into this? Or does the tech trade go, given the fact that people have gotten an AI trade that is so inflated in terms of expectations and timing? What does that mean to you, quality defensive?
You know, defensives are your classic defensive sectors, whether it's utilities, staples, healthcare, things that are positively correlated to bonds. Okay, they did not trade well, by the way, up until sort of April. It was really the quality growth stocks. Now, the other thing that's happened is the AI dream has taken, you know, a little bit of that luster has come off. And I really gauge that by what semiconductors are doing. It's not just NVIDIA, it's semiconductors writ large. And a lot of those stocks have really come off. And that makes sense to me. We just got overcooked on the whole AI theme. It doesn't mean it's over. We've written about this extensively. Like, we're not believers that this is going to change productivity materially in the short term. That's a long-term story. And everything kind of got bid up on that. So with that theme now gone, the market is looking for a new theme. On the growth side, there isn't one. So what it does is it hunkers down into defensive, high-quality assets until we get the next thing. Whether that's a bad outcome or a positive outcome, they're going to hide out in these areas.
Mike, you say inflation's over. We do have CPI data, though, today. So I'm curious to know, how do you think the market would trade if we get, say, a hotter print say is it too volatile, or softer print? Would the market start pricing in 50, or look at a softer print and say, wow, we are cooling down faster than even the Fed was expecting, and bad news really is bad news?
Yeah, well, when I said inflation is over, I mean the rate of change on inflation is over, and it's kind of over for equity markets, and quite frankly, it's over for the Fed. Where inflation is not over is the price level. Right? The price level is absolutely squeezing the heck out of businesses and consumers, and so it's like a vice. And so I don't think inflation is over in that regard. But what I would say is that a hot number, I think, is probably pretty bad for the stock market today. I'm not expecting that, but if we got a hot number today, then all of a sudden the Fed is going to stay behind the curve. They're kind of stuck. If we get a really soft number, then we go back to our old thesis, which is pricing power is gone. Okay, so we kind of need to thread the needle here a little bit too. I mean, break-evens are at 2% now. Break-even. So what are we talking about? We're already at 2%, and it's not like these things stop on a dime. They have there's a risk that we undershoot on the downside. That's good for bonds, and it's bad for stocks typically. And by the way, that's how the stock market, that's how the markets are trading. So I think the markets already understand all of this. Once again, they're going to do something next week to try and manage the situation. 25 is what we think, and they'll signal for more 25s, not 50s. And then what do they do with the balance sheet? I think that's probably the bigger wild card. Do they talk more aggressively about ending QT more quickly? Do they find other provisions to provide liquidity? That's the bull case in my view. That's where we could be surprised on the upside. Is there more liquidity coming into the system from other sources?
And after next week, then everyone's going to really be focused on the U.S. election. Goldman Sachs, RBC, they talk about how earnings will be much higher potentially under Trump administration if he gets his tax cut plan, right, rather than Harris, who's calling for 28%. How do you view next year earnings growth based on these two proposals?
Assuming that the economy is in a soft landing, okay, that the Fed hasn't overstayed its welcome, and by the way, I think that risk is still on the table. We're in the soft landing camp, but that to me is way more important than the outcome of this election in the next 6 to 12 months. So let's assume we're in a soft landing. Our view is the same. We think that basically Trump is kind of pro-growth, kind of bad for bonds, good for stocks, okay? And that's how we would look at it. And by the way, last night when the debate was going on, the betting markets kind of went in favor of Harris, and the stock market futures kind of traded a little bit, okay? But I do think the stock market is more pro-Trump. I mean, the stock market has traded better when his odds go up and vice versa. So
bonds are good under Harris and stocks are bad under Harris?
In theory. I mean, at the margin, I would say that's the setup. And the reason being is really taxes. Taxes is the one thing, and that requires some congressional support too. But to me, that's the big issue, not tariffs so much. Both administrations have tariffed. And then immigration, I think both parties are going to have to deal with that in some way. So taxes is the issue. Obviously, Trump is talking about cutting. Harris is talking about raising them. That's bad for stocks, good for bonds.
Wanted to ask you this question. I want to squeeze it in at the very end. Lisa was knocking on the door. Are utilities actually defensive? They're up like 20% this year, and it feels like everyone's getting whatever they want from utilities. It's defensive. It's attached to AI. What are utilities?
So this is a very interesting question. So, we agree. I mean, we don't think we were one of the first ones to talk about utilities as an AI beneficiary back in February, March. I think that's probably gotten a little overdone, to be honest. But now utilities are definitely trading with the bond market. So the defensive properties of utilities are, I think, dominating their performance in the near term. Here's the interesting thing about utilities. Their balance sheets are not great. Okay, so you got to be really careful with utilities. If it's going to be a hard landing, these things are going to start trading really poorly. So I would caution listeners, if utilities start trading really poorly and the stock market's not ripping, that's a bad sign. That would be a sign that, oh, we are actually getting closer to potentially hard landing risks. That hasn't happened yet. But if you look at things like low volatility parts of the stock market or defensive, they've gone almost parabolic. And if they start to sell off hard without a stock market rally, then I get concerned about hard landing risk. That's not the case today.